Welcome back to Cambridge House Live. I'm Vanessa Collette here at the Vancouver Resource Investment Conference. We're joined by Michael Berry. He is the editor of the Disruptive Discovery Journal. Welcome, Michael. Great to have you here.
Thanks, Vanessa. Good to be here.
Now, Michael, you present and lecture to the Federal Reserve and the FOMC, and you're going to be doing that about 3 times this year. Is that correct?
That's right. Yeah.
And what do you lecture or present to them primarily on?
Well, basically, what they want to hear is what's going on in the world outside of Washington.
Okay.
You know, sort of what things are happening that could impact the banking system, the credit system, the regulatory system. So normally I'll start their seminars off with a 3-hour presentation on the state of the world and geopolitics and what might be in their bailiwick this year.
Interesting. And do they listen to what you tell them, or are you advising them?
Yeah, I'm advising them. I've done it for about the last 10 years. And it's a nice scenario because everybody comes together across the country into Washington. And so I get to talk to people from the West Coast and Florida and Texas, all over the country that are dealing with some thorny problems in the banking system and also running the interest rate system involved in the country.
And what's your prescription for some of these problems?
To reduce debt, to make things a little more stable, and so to have interest rates so that people can expect less volatility in what's going on in the world.
Higher interest rates?
Pardon me?
To have higher interest rates or low?
To have a normal yield curve. In other words, to have a yield curve that is appropriate for the tenor of business activity in the country. So, to have low rates not at 0 like they are today, but to have low rates at 2 or 3%, and then maybe to have long rates at 6 or 7 or 8%. To have that normal yield curve that's shaped upward and that helps business make good decisions about how to finance activities going forward.
And the Federal Reserve is projecting to raise interest rates later this year. Do you think that's going to happen?
Well, they're projecting some of the governors and the bank presidents are for an interest rate increase in the Fed funds rate, which is the shortest term rate. And they talked about middle of the year, and then they talked about September. I think with the Swiss move this past week, I think that was a very major new move in the marketplace. The Swiss central bank basically said, we're not going to defend our currency anymore. We're going to let our currency increase in value. And that was a big deal. So I think that our Federal Reserve, the FOMC, the Open Market Committee, is probably going to think twice now about raising rates. I do not think they will raise rates this year.
Okay.
I don't think they'll do that. I think there's too much risk that they could slow the economy down more.
Right, spook it when it's just perhaps starting to...
I think it would create a lot of volatility in the business cycle, and that they don't need that right now.
Were you surprised by what happened with the Swiss currency, with the Swiss franc?
Yes and no. I think everybody was surprised because the Swiss central bankers, head of the central bank, had said right up until very recently, we're going to defend the currency. It's going to be up. We're going to maintain it. We're going to maintain the connection between that and the euro. And then they came out of nowhere and said, we can't do this because we're going to destroy our economy if we do that. So, you wondered if they could actually do it, and they have done. And now there are some serious issues that will go on in any activities that have been financed with the Swiss franc, because it's expensive now.
It is.
It's hugely expensive.
A lot of people have loans in Swiss francs, or people in surrounding countries are going to be defaulting. And
I would think there would be lots of mortgages. It might be kind of like what happened here in the United States in 2008, where we had a lot of housing values fall so quickly that mortgages went underwater and so on.
Now,
so,
why do you say that this is a big concession for central banks and leaves less options for them?
Because up until now, almost all central banks have decided that they knew what they were doing and that quantitative easing was the way forward. And it's pretty clear, and especially with 2 events that have happened recently. One, the Saudis decided to continue to pump oil, and that's forced the price of oil down. That's deflationary. And with the Swiss saying, we're not defending our currency anymore, we're going to live with a much higher currency relative to all these other currencies. I think the euro fell by 14% just last week. So I think that with these events in hand, we're in a new world. We're in a recovery world. Finally, we're probably in a recovery world.
It's an interesting move to make when you look at, in recent times, it's really been competitive devaluations around the world.
Yes.
And then you have, Switzerland going kind of the opposite way.
Yeah, well, Switzerland had a choice. They could continue to print and they could continue to put debt into their economy until they swamped themselves with debt, much in the same way the U.S. has done with its $18 trillion debt now. Or they could actually bite the bullet. And so this is really the first concession by a central bank that says, we can't do this anymore.
Right.
We've got to actually bite the bullet and
take the pain now.
Take the pain.
Right.
Exactly.
So what would when you're looking at the U.S. economy or at FOMC or the Federal Reserve, you would recommend that they take similar actions?
Yeah, I think the U.S. economy is the best of the worst. It is growing, and we get some numbers that look like 5% growth annualized, but I don't think the growth is really there. So we need to go through a 2 to 3 year process of deleveraging the global economy. That's a really important concept.
Okay.
And until we do that, I think we're going to be stuck in a 1980, circa 1980 Japanese world where we just can't get enough growth to escape the problems of overloads of debt.
And how do we go about deleveraging? What are the steps that we would need to take?
I think the banking system has to be involved and the regulators have to be involved, and we have to bite the bullet. There'll be some restructuring of loans. There'll be some paybacks that are underwater. There'll be some bankruptcies, and we restructure the system that way. It's just, and it'll be big. And now, it's not like the 1930s. This is a global
right.
Impact.
Right.
Because so many of these countries are in the same position.
So what are you advising investors to do right now with their capital?
This is going to be the next 2 to 3 years, in my opinion. I'm actually excited that all this has happened, Vanessa.
Right.
This is going to be, the next 2 to 3 years will be an opportunity for investors to look at companies, decide which companies are sustainable, where the disruptive discoveries are coming from, and to make investments. And so I think in the next 3 year period, to establish your portfolio, Chris, my son, talks about energy metals, for example. There's
Right.
a lot going on there that's really exciting. I like silver and I like gold at this stage of the game. I think they're really cheap, and so to buy those selectively, I think, is a great opportunity right now.
Excellent. Well, thank you so much for joining us today, Michael. It was a pleasure.
It's great to see you again, Vanessa.